Joann, a well-known national retailer specializing in fabrics and crafts, has been in business for over 80 years. Over time, it expanded to more than 800 locations across the U.S., with the exception of Hawaii. However, recent events indicate that many of these stores may soon shut down. Despite weathering economic downturns and industry shifts in the past, Joann now faces some of its toughest challenges yet. In May 2023, the company's CEO stepped down, citing a difficult year. More than a year later, the company has yet to name a permanent replacement. But the biggest shock came in March 2024 when Joann filed for bankruptcy, revealing more than $1 billion in debt. As a result, creditors took over the company, removed it from the stock market, and cut its debt nearly in half. At the time, layoffs were minimal and stores remained open, making it seem like a manageable setback. However, less than a year later, in January 2025, Joann filed for bankruptcy again. This time, store closures were officially announced, and unless a buyer steps in to keep operations running, liquidation is a real possibility. Many people have been asking what led to Joann's struggles, so let's break it down. Before we go on, please hit the like button and subscribe. This is the best way to support the channel and help others find this video. There are 5 major factors behind its decline. 1. A decline in sewing popularity. For decades, Joann has been the go-to destination for sewing supplies, generating over $1 billion in annual sales and dominating about a third of the U.S. fabric market. The company's origins trace back to the 1940s in Ohio, founded by German immigrants. Interestingly, the name Joann isn't tied to a single person. It comes from a combination of 2 founders' daughters, Joan and Jacqueline. Originally called Cleveland Fabric Shop, the company rebranded as Joann as it expanded beyond its local roots. By the 1970s, it had grown to about 170 stores, most of which were small and located inside shopping malls. However, during this time, sewing as a household activity started to decline. One major reason was the cultural shift of the 1970s when more women entered the workforce, leaving less time for sewing and home crafts. Retailers noticed the change and began scaling down or removing their sewing sections in favor of ready-made clothing. Intense industry competition. Rather than downsizing in response to falling demand, fabric stores went in the opposite direction, expanding aggressively to capture a larger share of the shrinking market. Joann and its competitors embraced the category killer trend of the 1980s, opening large freestanding stores in strip malls instead of shopping centers. They ramped up advertising, expanded distribution centers, and increased their inventory selection. By the 1990s, the market was saturated. Many companies had taken on debt to fuel expansion, but with customer demand declining, competition became cutthroat. This led to a wave of acquisitions and closures. Joann played a major role in this industry consolidation. In 1994, it acquired Cloth World for $62 million, giving it a stronger presence in the southern U.S. 4 years later, it bought House of Fabrics, one of its biggest competitors, for $100 million. By the late 1990s, Joann had solidified itself as the dominant player in the fabric retail business, rebranding all acquired locations under the Joann name. However, this shift also expanded its focus beyond fabrics to arts and crafts, putting it in direct competition with national chains like Michaels and Hobby Lobby. Third, private equity buyout complications. Following its rapid expansion in the 1990s, Joann was in a precarious financial position. The company had taken on significant debt from opening large stores and acquiring competitors. However, by the early 2000s, things were looking up. Sales surpassed $2 billion annually, and the company had successfully reduced its debt. Then in 2010, private equity firm Leonard Green & Partners acquired Joann for $1.6 billion. The deal, which involved significant leveraged debt, marked a turning point. While private equity buyouts often aim to streamline operations, they can also burden companies with financial obligations that become difficult to manage. For Joann, this meant being placed back into financial instability just as it was recovering from past struggles. Fourth, external economic pressures. Recent economic conditions have made it even harder for Joann to stay afloat. Inflation and rising interest rates have impacted consumer spending, making shoppers more price-conscious and pushing them toward cheaper alternatives. At the same time, online retailers have become a dominant force, further reducing foot traffic in physical stores. Additionally, the COVID-19 pandemic had a complex impact on the company. Initially, it led to a temporary sales boost as people stuck at home turned to sewing and crafting projects. Capitalizing on this, Joann's owners even took part of the company public again, raising over $100 million. However, once restrictions were lifted, demand plummeted, and the company's financial situation worsened. By the time of its first bankruptcy filing, Joann's stock had lost nearly all of its value. 5. Inventory and supply chain issues. On top of financial struggles, Joann has faced supply chain disruptions that have made operations even more difficult. The company's bankruptcy filing mentioned issues with inventory, citing an unexpected ramp down in production and, in some cases, a complete halt. Nearly half of Joann's inventory is sourced internationally, particularly from China, where tariffs and freight costs have been high. Making matters worse, Joann's weak financial standing has made it difficult to secure favorable terms with suppliers. Many now demand advance payments due to concerns over whether the company can meet its obligations. With limited cash on hand, Joann has struggled to maintain stock levels, leading to empty shelves and frustrated customers. What's next for Joann? Joann's situation remains uncertain. The company has already announced some store closures, and if a buyer doesn't step in, liquidation could be the next step. While the brand has managed to survive multiple crises in its 80-year history, the current challenges, ranging from industry shifts to financial instability, make a full recovery difficult. For now, customers and employees alike are left wondering what the future holds for this once iconic craft retailer.